All right, welcome everyone to today's webinar. Before we get started, just want to do a quick sound and video check. If you guys can both hear me and you can see the screen, if you could quickly type in a yes or something like that into the chat room, that would be good. Perfect. All right, let's give it just another few seconds or so, see if to kind of let things settle a bit here, and then we are going to get started here in just a second. What we're going to be doing today is we're going to make this webinar more, for lack of a better term, we're going to make it more interactive, if you will. So less PowerPoint slides and more just kind of looking at charts and looking at the market, and that's going to be a lot of the format going forward as well. So you can see how we put this stuff in motion, and so that you actually get practical experience out of it, and not just a sort of an academic exercise, if you will. Okay. All right, so let's get started, and we are going to start with just a couple of PowerPoint slides here to start off and give a little bit of perspective. And let's see what we have to say. So I'm going to try not to focus too much on current news, ABC Trader, because what this seminar is also going to be recorded, and it's supposed to be a little bit of an evergreen. We will look at the market, and then we'll look at that as well, but I'm trying to more teach you stuff than looking at the news for the moment, although we'll touch on it a little bit. The presentation is, by the way, still going on right now. It's only the one you're referring to. It's only like 10 minutes in, so I'm watching it with one eye on one of my computers. So anyway, what we're going to talk about today, guys, is the technical analysis part number 2. And if you sort of remember what we talked about over the past few seminars, essentially what we've done so far is kind of an introduction to various markets, and just kind of building the platform a little bit, talk about U.S. stocks, why they're good to trade, and so on and so forth. So let's continue and move into the meat of the presentation. Just for a little bit of perspective, again, this is the second part of technical analysis presentation. We already did a first part a couple of weeks ago where we just did a bit of introduction. And let me just give you a little bit of an overview again of what we talked about in terms of why U.S. markets are favorable to trade, why specifically U.S. stock markets are favorable to trade, and again, a lot of it has to do with liquidity and transparency. So there's a lot of volume and a lot of different types of players around the world. So I'm just going to quickly sort of mention to you again what some of these things were, some of these attributes to U.S. markets that make it attractive, U.S. stock markets. So for the most part, we're going to be focusing on stocks that have volume of at least 500,000, hopefully more. That's your 500,000 shares traded per day is what that's supposed to say. So let me just quickly give you another way of looking at this, and that's looking at the worst stocks to trade. I think some of the worst stocks to trade are stocks that are illiquid, stocks that have erratic behavior, stocks that are undergoing major lawsuits or accounting irregularities, and stocks that have no respect for technical analysis. So for the most part, what we're going to focus on today and really for the rest of the webinar series is stocks that are that are liquid, that are the opposite of what I have here. So stocks that are liquid, that show us a well-mannered behavior. They're not erratic. They don't gap up or down too much. In other words, they act well for technical analysis. So the U.S. stock market, for the most part, for at least the mid to large cap stocks, and some small cap stocks as well tend to act very well technically. And that's one of the main parts why U.S. markets U.S. stock markets are good to trade. But again, in order to understand why a stock market acts well technically, we have to understand, or in order to appreciate, I should say, that a stock market is acting well technically, we have to be able to understand why that is so. In other words, the liquidity, the transparency, the number of the absolute number, and the diversity in market players in the U.S. stock market these are all important parts to why the U.S. stock market tends to be a very nice asset class. So let's move on. Just a couple more overviews. Again, we talked about all the different sectors in the U.S. stock market. The stock market can be very well organized. You can look at it very much from a sort of top-down perspective, for the lack of a better term. And when I say top-down, I don't mean that you look at the U.S. stock market from a sort of macro perspective and you look and then go down. But really, when I top-down, I mean you look at the sectors, the industries, and then you kind of narrow down in single name stocks. Again, these are, if you have not noted this yet, these are the various sectors of the S&P 500. These are ticker symbols, the XLF, the XLK, and so on and so forth. And then, of course, you have different industry groups as well. So this is sort of your home screen, if you will, that I think everyone that wants to be active in the U.S. stock market should be able to be using this as your base. Okay. Again, we talked about how great U.S. stocks are for technical analysis. I personally think U.S. stocks act much better technically than most, if not all, currencies, and certainly much better than commodities on a multi-week to multi-month basis. On an intraday basis, the dynamics depend on the stock or commodity or currency pair in question. But from a multi-day to multi-week perspective, it's the fact that the stock market is open from a certain time period and closes at another time period, and closes a number of hours later, makes for a much more defined window within which market participants can play, and that, in my opinion, is also a big reason why technical analysis works better on U.S. stocks. Again, all considering, or a big reason being that there's so much volume. So the volume is really the key thing here. So again, one more thing to talk about here is sort of the top-down approach. We talked about that you want to look at the U.S. stock market from the approach of being sort of the eagle in the sky. You look down at the stock market, you see the different sectors and the groups, and then ultimately the stocks or even the options in that market. So that's really the way that I like to look at the market. This will make more sense in just a minute. The different sectors we talked about, I'm not going to go through these right now, but one more last thing here to kind of recap was the seasonal patterns, the cyclical patterns, volatility patterns, and then of course interest rates, and as far as the U.S. Stock market is concerned, the U.S. dollar. These are all different things to keep in mind when you look at the U.S. stock market, particularly if you look at it through the lens of technical analysis. As far as I'm concerned, these are, a lot of people will look at a chart and they will draw lines and look at patterns and moving averages and all those kind of things that we'll talk about, but they forget that you do have to keep in mind things like seasonal patterns, things like cyclical patterns, and these kind of things. And in the absence of using this, I believe the accuracy of using technical analysis is much less. So you definitely want to incorporate both types of analyses in my opinion. Okay, so these are the different sectors, and again, let's quickly recap. What is technical analysis? Really what it is a methodology for forecasting the direction of prices through the study of past market data, primarily through price and volume. Technical analysis works in all asset classes, there's no doubt about it: stocks, bonds, currencies, commodities, and it works in all time frames. Again, it's all a matter of it's all a matter of having a process to approaching the market, and that's what I'm going to show you guys here as well with technical analysis. So we can break technical analysis down into two parts. We can break it into, in my opinion, we can break it down into price indicators, and number one, and number two, momentum indicators. Okay, so price indicators, momentum indicators. And when we talk about price indicators, we're talking about things like moving averages, trend lines, patterns, and even Fibonacci analysis. Momentum has to, you're looking at things like MACD or RSI stochastics. We'll talk about all these things. And then arguably you could also break that into volume analysis, or maybe even into time analysis would be two potentially more bits to add here. But to keep things simple, I think these two are really the major two ones you want to focus on. Okay. All right. So I am a big proponent of keeping things simple when it comes to technical analysis. I think simple moving averages and trend lines are, your best friend. I don't think it needs to be much more complicated than that. And we will build on that. And really, for the U.S. stock market, technical analysis works very well. So it's a beautiful marriage as far as I'm concerned. All right, so let's quickly go back and sort of look at our charting platform here, the Roboforex charting and trading platform, which I think is certainly a good way to trade U.S. stocks. There's, I think, over 3,000 instruments available on the Roboforex platform. So let us dig in here and have a bit of a look. And to the point of some of you guys that are leaving comments behind here, we will definitely now move into looking at various different stocks and so on and so forth. So primarily, to gain perspective, I like to use some very simple moving averages, and these moving averages really, in this case, are the 50-day moving average in yellow, the 100-day in blue, and the 200-day in red. So what I'm trying to tell you here is, twofold. Number one, make sure that whatever moving averages you want to use, although I like these moving averages they work quite well. Whatever moving average you use, make sure you use the same color. So if you're going to be using, let's say, the 200-day moving average for your intermediate term time frames, make sure you always make it the same. Make it the same color. Okay, so if in my case I always make my 200-day moving average the color red, I make the 50-day the color yellow, and so on and so forth. Because so to me, when I open up a chart and I look at the color of the moving average, I don't have to think twice about it. I know exactly which one it is. Okay. Now there's also the little sort of diagram up here. But it makes it easier and quicker if you can just look at and understand which color you made a moving average. Okay, that's just a little bit of a trick I want to give you, and now let's move on to the next bit. So the second big tip I can give you when you use moving averages is to understand that if you're going to use a specific set of moving averages, they're not going to work for every single stock the same way. In other words, if you are going to use, let's say, the 50-day moving average, you can see the 50-day moving average works okay, not too badly for this specific stock that we're looking at. Okay, but I can tell you, for example, by my own experience of doing this for a long time, the 50-day moving average is one of the worst ones you can use for like the S&P 500 over time. There are going to be periods when it works okay, but for the most part, it's a pretty useless moving average because, there's multiple reasons for that. Number one is probably just because too many people focus on it. So too many machines and algorithms are gunning against it. And number two, if you just look at it through the lens of the characteristics of the S&P 500, it's just not it's just not a time frame within which the index makes important moves, and that's maybe a bit of a difficult thing to understand right now, but you'll see this as we start going through different examples. Okay, so that's just a little bit of a word or a recap on moving averages. Just make sure when you use moving averages, I use different sets of moving averages. I use the ones I just mentioned here, the ones you're looking at here. I use those for my intermediate term price action or analysis, and then I use more near-term ones for my multi-day, multi-week time frame. I use things like the 21-day moving average is usually a pretty good one. These are no secrets. If there's someone out there trying to tell you that they have a new combination of various moving averages that is a surefire thing, I promise you it's not the case. So the biggest mistake that people make when using moving averages is that they essentially use them for specific entry and exit points, and that's probably one of the biggest mistakes you can make. So what's important about technical analysis in general, and we touched on this a little bit in the first technical analysis webinar a couple of weeks ago, what's much more important than a specific move above or below a moving average by price is really what does the moving average tell us, or where does it coincide with other things on the chart? Okay, so like for example, where does the moving average come into play, and how does it relate to, say, a specific horizontal resistance level or horizontal support level or whatever? There's so many different things that can happen. So it's never just one thing. Like for example, if we just look at the S&P 500 here for a minute, and you can see here at this point right here, the S&P 500 dropped down to its 200-day moving average. This was just not too long ago, in early November. And yes, the 200-day moving average ended up being support, but there were other things that came into play there. For example, there was a Fibonacci retracement level that came into play. In fact, we had an exact, I believe it was a 50% Fibonacci retracement. So from down here, back up, back down, we had a 50% retracement. Okay, we called it's actually not even a Fibonacci retracement, but it's just a 50% retracement from the move down, back up here, and it happened to also coincide with the 200-day moving average. So yes, it was nice to see a bounce off the 200-day moving average, but that in and of itself is not enough. Okay, there are other things that need to take place for us to get better probability buy or sell signals. Okay, the bounce off the 200-day was only just one thing that took place. Okay, you will see also that there were other things that came in. Again, we talked about the retracement just now. Also, we had a nice sell off and then a quick gap up on that specific day here, which I guess that was the day after, or just the day before the election, or the day of the U.S. election, I believe, last November. And so it's the way in which we bounced off the 200-day and gapped higher the next day. That's another confirmation. But if all you see is a stock, drop into a moving average or climb above a moving average or climb below one, that's usually not enough. You really have to look at multiple things. Yeah, so that's kind of what I'm trying to say. Okay, perfect. All right, so now let's take this a bit of a step further, and one of the things I wanted to talk about today is a bit of an introduction to pattern analysis, and then we are going to be looking at some single name stocks and securities. I see some people have some questions on single name stocks as well, so we're going to be looking at that in just a little bit as well in the second half of the webinar, maybe in about 15 minutes or so from now. So one thing that I wanted to talk about, we just quickly mentioned, keeping it simple. I do think that's very important. Let me get back to this thing. So let's see. We talked about moving averages, so let's talk about patterns. Patterns is what I want to talk about a little bit today. And the most important thing when we talk about patterns is to understand that just like moving averages, they're better to be used for reference points. And I don't know how many of you are familiar with the different namings that we have in that we have for different patterns. We'll talk about them in just a minute. But one of the most common mistakes I see people make is this whole, focusing on names of different patterns or of different technical formations, even of different candlestick patterns, and there's all these different namings, and the reality is that the naming ends up confusing traders and investors, and this may not make sense just yet, but I assure you that it's something that will be pretty clear shortly as we go through it. So without further ado, let's talk about that. Let's talk about the naming of these different patterns. So let's again stick with the S&P 500 for just a minute, just because it's a pretty straightforward index to look at, and one that I think most everyone should at least be somewhat familiar with, or at least have heard of. So let's talk about the very simple pattern, which I'm going to just, for lack of a better term, I'm going to call it something like a bull flag pattern. Okay, and what the pattern is here is basically these two quasi-parallel lines, or I guess we can make them parallel. They should be pretty parallel. Okay, you can see these are just about parallel, these two lines here that I just drew. And basically what that is we refer to that in naming terms, we refer to that as a bull flag pattern. And is anyone in here familiar with this name? Again, I'm trying not to do too much naming, but nonetheless, just to kind of familiarize with yourselves with this, it's important to at least be somewhat aware of what the names are. So the bull flag pattern basically just is a consolidation pattern. So it basically just means what we have here is we had a rally take place, right, like this, right? So that's your flag actually. You see this pattern here, just the rally, and then basically the S&P 500 started to go sideways. Well, actually, it didn't go sideways. It actually started trending lower, right? But all of it took place within a very well-defined pattern, okay? And then ultimately we had a breakout, which took place right here, which is a few days after the election, the United States election in November, okay? And so if you zoom out a little bit, you can see the pattern is right here. You can see that what this entire price action was, through the lens of this longer term chart, this was a big bull flag pattern. You can see we saw stocks continue to the upside once we had this consolidation phase. Okay, so much is made of these different consolidation patterns, and let me just quickly go in here and let's talk about these different patterns. So there are multiple patterns out here. Let's list them quickly. I'm going to list the names. Again, I don't want you to focus on the names, but I want you to be aware of what the different types are. So once you then look at a chart, I don't want you to think of the name. I want you to think of the pattern itself, because that's going to clarify much more what you need to do. So things like bull flag patterns. There's also bear flag patterns. Then there's things like sideways consolidation. That's just when the market just literally just goes sideways. I'll show you that in just a minute. Then we have things called wedge pattern. Then we have rising wedges. Falling wedge as well. Okay, and I'll show you some of these here in just a minute. So I'd like to spend a good part of the remainder of today's webinar on these patterns, because they're very, very important to understand, and they work very, very, very well in the U.S. stock market. Okay, so let's go back and let's start looking at some of these patterns. So we just talked about the bull flag pattern, and like I said before, what's also important when you look at the stock market is to understand that you basically have these confluence areas of support. And this is a bit of an advanced topic. We'll talk about this much more in the next webinar. I believe it's going to be this Friday, so that's going to be the third webinar on technical analysis, and we'll talk about it much more also for the remainder of our webinar series here for Roboforex. But basically, consolidation patterns are where multiple things come together. We just touched on it before, so you can see a moving average in and of itself isn't really all that important. What's important is how the moving average coincides with other things. So, for example, the lows here following the or just before the election results for the U.S. stock market coincided with the bottom of the bull flag. Okay, that's this. So the bottom would be here. It coincided with the rising 200-day moving average. That's that red line. But it also coincided with this diagonal resistance or support line. What used to be resistance, then it became support. And it coincided with that 50% retracement we talked about before, from the lows here, back up, down here, a 50% retracement of this entire move took place. Does that make sense to you guys right now? This is a really, really important concept. So within all this, you can see that we had a bull flag pattern take place, and the bull flag pattern, as you can see, is a consolidation pattern, and it tends to resolve stocks to the upside. Let's look at a bull flag pattern a little bit more near term. Here we go. Let's look at, for example, shares of Bank of America, which, by the way, is just about ready to report earnings, I think, on this Friday. Okay, so let's look at, for example, Bank of America, and let's look at it here. And you can see this stock had a very nice bull flag pattern here. This is more near term, right? And if you use the Roboforex platform, you will find it very intuitive to use these drawing tools. So you can see what took place. We had a very nice rally here off the summer of last year, and then we started consolidating here into October, and then just before the election started, this stock actually started rising once again. So again, a continuation pattern. And look at this, just like I said before, there's multiple things that came together in this stock, you know, when it started breaking out of the bull flag pattern. It had a nice breakout here. It also found support at the 50-day moving average. That's the yellow line. You can see the 50-day moving average for this stock is actually a pretty good reference point. You can see how it acted as resistance, then it became support, and then it became resistance, and then once it went back above there, the stock, then it became support again, and it's been support ever since. Right? So that's your bull flag pattern. Now, we can also look at the bear flag pattern. Let's just stay on this stock, for example, and you can see if we zoom in a little bit closer here, you know, bear flag patterns happen just as well. So we can look at these patterns like this. Okay, look something like this. So you can see we had, you know, a sell-off, and then basically what the bear flag pattern is just the inverse of the bull flag pattern. So what happens is you have a sell-off, you then bounce because sellers got very tired or exhausted. They then started to bounce, and then the stock started to drop lower, right? So just like here, where you saw that we had a rally, and then the stock started to consolidate because buyers got tired, so they needed to rest, and then we consolidated for a few weeks, and then finally we had another move higher. So that's your bull and bear flag patterns. Again, we will talk about them much more throughout the rest of the this webinar series. But for right now, keep those two in mind. Then we can always look at markets through sort of the lens of sideways consolidation. So I'm just going to go through an exchange traded fund here just to kind of show you. It's called the XLF, which is the financial sector ETF of the S&P 500. And you know, we can, and this is now where we're going to start looking at showing you, you know, how certain things, you know, can be called different patterns depending on how you look at it. Okay, so let's look at this XLF, and you can see that this has been a pretty clear consolidation phase now for the past few weeks. Now, we can draw, this consolidation phase in multiple ways. We could say, okay, well, number one, the ETF has basically just gone sideways, so it's in a sideways consolidation pattern. Or if we want to be a little bit more creative, okay, we can also draw the lines a little bit more like this, and we would then call it something like a wedge pattern, okay, right? Maybe we even draw it something like this. Now, the point I'm trying to make is that, as you can see, it doesn't, and this is the point I was trying to make before, it doesn't matter whether we call this pattern here a sideways consolidation pattern or whether we call it a wedge pattern. The fact is that this stock is consolidating. It's consolidating in a tight range, and it is consolidating basically sideways, right? So, one of the biggest mistakes that people make in the stock market is they think something has to happen every single day in every single stock, and or in every single asset, in every single currency, or every single commodity, and that's just simply not true. The historic facts are that the stock market in particular goes sideways about 80% of the time. So when we look at a chart like this, it's not important to give it a specific name, right, of what that pattern is called, but it's important to understand what this stock is doing. And the only thing this stock is doing is consolidating. And that means that for the most part, unless you're maybe day trading this stock, for the most part, right now, there's very little to do. In my opinion, this is a stock you want to stay away from, or in this case, this is an exchange-traded fund, an ETF, which you can trade, as you can see, on the Roboforex platform. Okay. So when you look at this kind of a pattern, you can call it 1,000 different names. I'm sure you can come up with your own names as well, but the point is that the names are irrelevant. What's important to understand is that this is a sideways consolidation phase, or excuse me, it's a consolidation period, regardless of what you want to call it. Okay, I hope that makes sense. So again, to reiterate, what I'm seeing a lot of people do is they read a book on technical analysis, and then what happens is they read all these different pattern names, and then what happens is they go out and they try to find these patterns. They make a huge deal whether a certain consolidation phase in the market in any given stock is called a wedge or a bull flag or whatever else you may want to call it. And technically, it really doesn't matter what it's called. The point is that the stock is going sideways, and really, for the most part, or at least for today's presentation purposes, there's very little to do, and in fact, you should probably stay away from it. Okay, so that's something that took me many years to understand, is this whole notion that markets mostly do go sideways, so that whatever sideways consolidation pattern you're looking at, it doesn't really matter what they're called. Okay, so I hope that makes sense. That's some of the best advice I can give you when it comes to using technical analysis and really how to trade markets in general. Okay, so let's look at something else. Let's go on and let's look at things like rising wedges and other types of a little bit more of an advanced pattern. And for that, I believe we can look at something like, I'm just trying to find a stock that had some of these wedges that I can show you. Okay, let me just quickly zoom out a little bit to show you. Okay, so technical analysis is a very visual way of analyzing markets, and so what I'm going to show you here is a pattern that I consider to be one of the better ones, and it's called essentially it's called a rising wedge. Okay. So let's have a look. Let's draw a couple lines, and I'm going to show you what I mean. And this is not your, classic, rising wedge, but that's kind of why I wanted to show you this. So if we zoom out, you can see the pattern here that we're seeing in this specific stock. It's called First Solar, just so you know. It's also, obviously, you can trade it on this platform. And basically, what you see is we have a stock that, you know, dropped here, it topped out, and then it started dropping, and then basically we had this entire big, you know, price action take place, which was, as you can see, several months long, but ultimately it started resolving to the downside. Okay, so one of the most important, in my opinion, one of the most important aspects or parts of your analysis has to be multi-time frame analysis. And if we look at a market through the lens of multi-time frame analysis, you'll start to see in just a minute what a big difference that makes. Okay, so I'm going to give you a little bit of an introduction on multi-time frame analysis in just a minute. So let's see here. Let me see if I can do this. I think this is now a weekly chart. Okay, so now what we are doing is we're looking at the same chart. Let me get back to this point. Okay, we're looking at the same chart, right? And each one of these bars is now 1 week, not 1 day. All right, and you can see that we had this rising wedge pattern, which it's not a classic rising wedge pattern, but you see the idea. What we have is sort of price action where you can draw sort of like a rising wedge. And the weekly bearish reversal, as I like to call it, was very, very clear. Okay, and so you would not have seen this as clearly on the daily chart. We'll go back to the daily chart in just a minute. But on the daily chart, but on the weekly chart, you can see the importance of having, you know, a multi-time frame approach. So I can't stress enough how important multi-time frame analysis is, and I'm sure this will make more sense to you, you know, after another few sessions of this webinar series. So for right now, just keep in mind that looking at the stock market through both a daily, weekly lens, and maybe even maybe you're a more near-term trader, then maybe you look at it in other time frames as well. Okay, so that's your rising wedge, and we have things like falling wedges, which is basically the opposite of that. I will show you one here on First Solar. To me, you know, again, you can draw them in many different ways, which is part of the reason why technical analysis is a little bit subjective and much more, objective and much more an art than a science. But here you can see the same idea. This is now a falling wedge, right? So we have this sort of falling wedge, and then ultimately we see a breakout to the upside. Again, we can use a multi-time frame approach. So that's the daily chart. Let's move over to the weekly chart. And the weekly chart pretty clearly shows you that we had a clear break out of this range here on this specific week here, which was, I guess, one of the last November weeks or the early December weeks of 2016. Okay, and so far this has not led to a huge move, but you can see that the analysis stands very well. Okay, so those are your rising and falling wedges. That's your consolidation phases. They come in different ways. You can also look at consolidation phases or patterns, you know, in ways that are a little bit more creative and a little bit less textbook. So, for example, you know, if you draw your consolidation phase, something like this, okay, and we draw this one like this, you can see there's a very clear consolidation phase, and ultimately that broke to the downside, right? So the drawing lines part of is an important analysis part, in my opinion, that any technical trader, particularly in U.S. stocks, needs to do every single day or every single week, depending on what time frame you operate in. Okay, so and you can see there's a clear breakdown here on the weekly basis. Okay, so now we actually have a very good question coming in. It's actually not. He's saying it's a simple question. It's actually quite a complex question, but it's a very good question. And so what he's saying is, or what the question is, specifically, and I paraphrase, how do you manage situations when you have a pattern, like the one we're just looking at here, for example, right? But you have an upcoming corporate event. Okay, very, very good question. You know, obviously you've done this for a bit, so you understand. You have probably, I'm assuming you have probably been in situations where you have a trade and it looks good or it doesn't look good, whatever, and you have, let's say, an earnings event coming up, or maybe a major economic data point. So my solution is very simple, even though it took me a long time to do this. It all has to do with being able to separate your investments or your trading account into different time frames. So let me explain what that means. So for the most part, if I am in a trade for me, by definition for me, is something that I'm in for a few days. Sometimes it's a few weeks. At most, it's a couple of months, right? If I'm in a trade and I have an upcoming corporate earnings event, I most likely, like 90% of the time, I will exit that trade and then reevaluate after the earnings event. If it's a long-term investment, however, something that I'm intending to keep for at least, you know, let's say 8 to 12 months, most likely, unless something has dramatically changed, I will remain in that position regardless of whether there's an upcoming earnings event. What I may do is I may reduce the position size. Maybe I'll protect it a little bit with some puts or some calls. But for the most part, I would try my best to stay in it for the longer term stuff. So let's look at an example here. Okay, so let's look at Bank of America. Let's go back to the stock price of Bank of America. So let's say you still own this stock, and maybe you bought it in early December, and now earnings are coming out in 2 days from now. Now, for me, if this is a trade that I intended to be in for a few weeks, at this point I would simply get out. Okay, that's really that simple. And then now we'll see what the stock does after the earnings event. Maybe it gaps down, maybe it gaps up, and you wait for the reaction to settle. So after an earnings event, you don't want to immediately jump into a stock, or you don't want to immediately buy or sell a stock. You want to give it some time to tell you a little bit more about what it actually looks like it wants to do. Okay, so that's really the way I look at it. And it does, you know, okay, so this person, ABC Trader, is asking another question here, or is making a statement that he thinks it depends a little bit on your strategy as well, on your trading strategy. And I would agree, but I would also disagree to some extent, because it doesn't really matter whether you are doing a directional trade or a mean reversion trade. The problem is, let's just stick with the example here in Bank of America. The problem is that the stock is now consolidating sideways, right? We can all agree to that. I mean, there's no doubt. It doesn't matter whether you are whether you own the stock for a trade, or you are short the stock for a trade, or you are in some sort of an options trade, right? It almost doesn't matter, because if the stock makes a meaningful, let's say the stock after earnings rallies 10%, or maybe it falls 10%, it's almost a binary outcome. In fact, it kind of is a binary outcome. So that's why I'm saying it almost doesn't matter what the strategy is you deploy. It has more to do with your time frame. So let's say, you know, let's give you another example. Let's say this was not a long-term position, but maybe this was something like, I personally also like to trade some options. So let's say I am in a specific option trade that I like to do, where I like to sell out of the money call or put spreads. And usually I do that, with options that expire in about 2 to 3 months into the future. Now, again, there I'm doing a bit of a different trade because I'm using options. But the main differentiator between that trade and the one that I could be in right now, I'm not, but maybe just for example purposes, let's say you were long Bank of America stock. The big difference is that, with that other trade, I have 2-3 months, of time. Whereas for the more near-term trade, which is my intention was always to stay in it for maybe a couple of weeks, not much longer. My time frame is not appropriate to stay in to stay in the stock through the earnings season, because there are too many different factors that can move the stock. I've seen everything. I've seen good earnings reports lead to bad sell-offs. I've seen good earnings reports and bad guidance lead to rallies, and vice versa, and any combination thereof. Sometimes all it takes is one big buyer or one big seller after the earnings report to change the entire picture, and then momentum guys get on top of it and they rally the stock for days or weeks, and vice versa. Okay, so there's the herd mentality cannot be understated in the stock market. I think that's a very, very important point. Okay, so let's talk about earnings season for a minute, just so you have a little bit of an idea of what I'm talking about here. So let's quickly go back to the S&P 500. We'll look at the SPY ETF, which is representing the S&P 500, and zoom out a little bit. And really, if we look at this index now, you can see that we had a very, very strong move, after the election results, and we're consolidating. We're very much like this chart doesn't look a whole lot different from what we just looked at in Bank of America. So, not only is Bank of America and the financial sector in a consolidation phase, but so too is the entire S&P 500. So right now, and if you want to talk about current events for just a minute, there's lots of reasons why, in my opinion, it's probably a good idea to take a bit of a pause, a bit of a step back, because we do have the inauguration of the new president. That's going to happen on January 20th, as I'm recording this today. And then we have earnings season, like we just said. So really, the consolidation phase that this index is in right now, in my opinion, does not bode well for making a lot of directional bets, right, or non-directional bets, because of these two big events that are basically just around the corner. You could say that maybe we've already broken, and this is actually another good example, or another good point. So let's quickly go back to patterns, and we talked about this potential bull flag pattern here, and we could make the argument that this bull flag pattern, again, this is your pole of the flag, right? This entire thing, or maybe just this bit, doesn't matter. And we've had a consolidation phase here now, which we could look at as a bull flag. But until we actually make another move higher, this could also be looked at as just simply some sort of a sideways consolidation phase, which, looks a little bit more like this, right? You guys see that? So for the most part, the price action since mid-December has been taking place within a very well-defined range. All right. So that's the tricky thing about technical analysis, is to be able to understand that technical analysis can be somewhat subjective, or objective, and to be flexible enough. So, if you go back to Bank of America for just a minute, you'll see that, whatever happens after earnings on Friday, we have to be open to it. If the stock gaps higher, maybe you buy it. If it breaks lower below this range, maybe you sell it. What if the stock drops lower and then quickly starts going back up? Well, if that happens, you probably buy it. What if the stock rallies first and then quickly sells off? Well, then you'd probably sell it. Okay, so you can see that there's multiple different ways of, that can happen, different outcomes that can happen out of these different patterns and around these different earnings day, these different events that can happen, whether they're corporate earnings events, maybe they're economic data points, and so on and so forth. Okay. Okay, so now ABC Trader wants to look at a couple of tickers. So you want to look at TSM, and let's see if we can find some sort of pattern that may be reflective of what we just talked about and what we just learned in today's webinar. Okay, so TSM, of course, is Taiwan Semiconductor. This is a semiconductor stock. They compete with the likes of Intel. And if I look at TSM right now, what I see is a couple things. I see, number one, I see a bull flag pattern, which looks like this. Okay, and you can see though that we are not yet breaking higher, particularly if you look at this on a weekly basis. Where's the weekly chart? Oh, here. Okay, if you look at it on a weekly basis, you can see we have not yet had a weekly close dramatically above this bull flag. Okay, so in my opinion, this stock is just stuck in a range through that lens. Of course, we also have your 50 and 100-day moving averages. They're still pointing lower, so I don't think the stock is ready to break higher just yet. And once it does, then price is the only really and the ultimate arbiter, which is just a different way of saying that price is the most important thing to watch. Okay, then he also wants to look at OCN, which is Ocwen Financial Corp. All right, and if we look at Ocwen Financial Corp, there's also a couple things. We actually have, what we could potentially consider as, well, let me draw it in, and you'll see what we're talking about. Okay, so we're looking at this pattern right here, which, in my opinion, also coincides with this kind of thing here. All right, so we have support, then became resistance, and now it's resistance once again. So OCN really needs to be able to get above, let's call it, maybe $6 or so in order for it to have better upside momentum. Okay, so again, you can see how the combination of very simple patterns and lines can give us a lot of perspective. So the most important thing to understand is that these stocks are in a consolidation phase. Okay, so OCN, it may be bullish, but it's still consolidating right now. So until it starts breaking past resistance, you have to respect where it is. You have to respect that it's still consolidating. This stock has not done anything since mid-December. It's just consolidated. The longer-term trend is higher, no doubt. But what I'm telling you is that I don't think that trend will continue higher until it actually breaks above $6 or so. And if you go back to TSM, it's the same idea, right? So I'm not telling you the stock is bearish. I'm just telling you that the stock needs to confirm a breakout. Okay? So that's the way I would look at it. Okay. Cool. Well, listen. Thank you everyone for joining today. I hope this made sense. I think this is a very important part of technical analysis, understanding patterns and understanding how they relate to other other parts of technical analysis. We'll take it another level deeper next week. I think actually no, on Friday, so in 2 days from today, we'll do technical analysis part 3. And until then, I wish you well, and I'll talk to you soon.